Hey everybody, Chris Matan here, Real Estate Machine Show. We're going to talk apartment buildings today. I've been in and around apartment buildings for the better part of 30 years, 30 years plus, really, as a buyer, a seller, a broker, a manager, um, anything. I've really done a lot. Janitor. I've been a janitor for a while. So, apartment buildings are really something that's in my blood for a long time. And I have a bunch of opinions about it. I have a bunch of lessons that I can share with everybody. But I want to talk also about the current state of apartment buildings and apartment building investing. Physically, I'm in Cleveland, Ohio. I'm in Northeast Ohio. I grew up in the Chicago area, the Chicago market. I've got some ties to South Florida. So I've got a bit of a pulse on three very, very distinct and different markets and what the sellers look like and what the buyers look like. Kind of all the sellers are along the same lines. They're all chasing those 2021, 2022 price points and cap rates. And everybody wants as much as they possibly can for the building, and everybody thinks their building is worth more, than maybe their neighbor because of their blood, sweat, and tears and what have you. And sometimes that's the case. Location is going to drive a lot of the value. Obviously we're looking at income and expenses. We're looking at occupancy, and overall operations. And as a buyer or an investor, the flood of syndicators that have been on the scene for the last, 5, 6, 7, 8, 9 years, they're starting to go away also because they're not able to, number one, necessarily drum up raise the capital because the prices have become so high. The margins are just smaller than they were. A typical syndicator wants to get paid themselves, right? So when you have to factor all that in, to the operation of the property, the income and then the expenses, and then you got to pay your, a rate of return to your investor, and then you want to pay yourself, those days are kind of gone. You can't evaluate this stuff just on a simple piece of paper anymore. Actually, in fact, you can if you're experienced, but what you plug into your figures is where people are getting into a lot of trouble. I want to highlight a few things that I do from a brokerage standpoint when I sell a building. I typically work with sellers, and I like to work with sellers. I like to work with listings. I like to have a little bit more control over the transaction. Um, and I like to have buyers and brokers come to me. I want to be that gatekeeper, so to speak, to the property. And sometimes these deals are on market, sometimes they're off market. But the first thing that I do when I meet with a seller or we're gearing up to bring the property to market is to really get a good view of the income and expenses. Starting with the income, I look at every lease. I want to know, let's see, three, four things in a lease. I want to know the current rent. I want to know the security deposit, if any. I want to know the move-in date, not the lease start date, but the move-in date, if possible, because this could be a long-term tenant. It could be a tenant that moved in 2006, right? Just because the it's a fresh lease that started in 2025, that doesn't mean that the people have only been there for 6 months or a year. I want to know how long the people have been there, and I want to paint a picture on the long-term occupancy. And long-term occupancy means a couple things. It means the rents are really, really, really artificially low, and the seller is not doing anything to really maximize the income of the property. Or the tenants are so happy with the way the building is being operated that they're there because they want to be there and they grow with the building and they have annual increases every year. So that 2020 that that rent amount in 2006 might have been $600 where now it's $1,600 and they're happy to grow with the building. So that's a testament to me, that's a testament to ownership and the way that they operate the building. So I kind of got a little bit off target there. So I want to know the move-in date and I want to know the expiration date of the lease. If there's no lease, I want to know there's no lease and it's a month-to-month kind of situation. So those four things really create your rent roll and your income. In addition to that, you may have a parking line item. You may be charging for parking. You may have a laundry. You may get reimbursed for utility. There's a bunch of other things that, you may drive income out of the building. But the first and foremost, I want to look at the rent. I want to look at the apartments. I want to see the size of the apartments, one bedroom, two bedroom, studio, etc. I want to see if there's single plumbing or double plumbing, one bath, two bath. All that stuff matters. If you got a bunch of three-bedroom apartments, that's going to look differently than you have a bunch of studios. To me, regardless of what the income is, I don't think that you establish a cap rate to a studio building than you do to a two and three bedroom, two bath building. Those are two different animals. Your occupancy, your turnover may be much higher in the studio building than it is in the two and three bedroom building. So anyway, all those things kind of go into effect. And I look at those things and I think about those things and I talk through those things with the seller so that I can give him an expectation, or her, set the expectation early on who that buyer is going to be, what they're going to look for, and how we need to position the property when it comes to sell. Then the second piece is expenses. And this is where everybody, I think, really, really, really gets in trouble, because the expenses is what's going to determine your net income. And the net income is what's going to kind of factor in where your cap rate is. But we have to agree, number one, what the income is, what the real expenses are, and then determine what the real net income is. And we have to go to market that way. We can't go all in on all this pro forma stuff anymore. Buyers aren't buying it. They're going to do their own underwriting. So there's no point. The way that I look at a pro forma from an income standpoint, if you've got 10 apartments, right? And the highest, and they're all two bedrooms, and you got the highest one that's 950 and the lowest one that's 725, right? My pro forma is going to show all 950 because that's the highest rent that they're achieving right now. That's not to say that you can dial up the unit or maybe go out to market and get 1200. If you want to do that, if you can do that, if you think you can do that, you underwrite it that way. I'm going to underwrite it what it's currently achieving. And I'm going to explain that to the seller. Because if the seller tells me that I can easily get 1200, I'm going to tell them, let's do this. Let's meet back in a year or 18 months, get everything up to $1,200, and then you're going to see what the difference is in the value. If you don't want to put that work in, then you got to sell down here. If you want to put the work in, give it 18 months, you're going to sell up here. And it's a business decision that you have to make. Most sellers, when they're gearing up to sell and they really want to sell, they're selling. And they're going to sell for where it's at right now. Try to maximize that value as much as possible. So back to expenses, there are basically the fixed expenses, right? The basics, the utilities, the real estate taxes, the insurance. Maybe there's a management you can put in there, a management factor, a vacancy factor you can put in there. Repairs and maintenance and capital expenditures and supplies, staffing, payroll, janitorial, all that stuff. Some of that is going to be, everybody's going to kind of plug in their own thing. If I go back and I look at, sometimes I'm going to ask the seller, depending on how it's not even sophisticated, but it's nice when there's a bank account that's dedicated to this particular property, because then all of the income that's going through and all the expenses that are going out. You can then categorize everything. If they're a little higher level and they've got a QuickBooks account and they're really kind of categorizing everything that way, you can really paint the picture on where the real true income and expenses are. Now, sometimes there's going to be expenses in there that have nothing to do with the building. And, that's just the way that the building is being operated by that particular owner. So you can kind of fix and flip and mix and match, what you need to put on your sheet, what I put on my sheet, and, really try to get to that real number so that there's no, you're going to go into due diligence anyway. So you might as well put the numbers in there the way that they are and the way that they should be, or at the very least have an explanation or a little asterisk next to it. But I want to know going in what the real numbers are, what the performance of the building is, and this is the way that we're going to paint the picture and bring it to market. And also by doing that, you may have a decision to make. We may want to take it to market to the open market and list it all on all platforms and expose it to everybody. Or we may not. We may want to kind of zero in, keep this off market, expose it to some select qualified people, sometimes local people that are they're going to buy it. They're going to close quickly. Their due diligence and their inspection periods are going to be really, really simple. They'll get their eyes on it. They know what they're doing, and there's a ton of value as a seller to work with a buyer like that. You may chase that number, and I've done it. I've done it as a broker. I've chased that high number and I've gotten it. But between the contract to close, it could be extended another 3, 4, 5 months just dealing with Mickey Mouse bullshit stuff, and if the seller is up for that game, we can play that game and we can go there. My philosophy is that I'm not retiring on this deal. It's not my timeline that matters. It's the seller's timeline that matters or the buyer's timeline that matters. I accommodate to that. But if you want a quick close and you want to get things done and you want to work with a highly qualified buyer that knows exactly what they're doing, you may have to take a little bit a little bit off the price and compensate for that because there's a ton of value there. If the price is your number one thing, then you have to, sometimes, put up with some shit and kind of grind through the transaction. So, those are the kind of the two things that you have to think about. Now, I've had sellers, I've had buyers that I've worked with. I've been a buyer, I've been a seller, and I've managed property. And what I feel is something that sometimes sellers are just not ready to sell. They want to own, and they're at that position where they don't want to make massive investments in the building. Maybe the building is operating smoothly. They've got low debt. The apartments have been renovated to a degree where they don't need any meaningful renovation. The building is, for all intents and purposes, is in good operational shape. How do you add value there? What you have to do is you have to maximize efficiency more than anything. And you have to use technology from a administrative standpoint. You have to use technology with the communication with your tenants. And listen, if you have 2 units, it's not that big of a deal. They have your cell phone, they're calling you, whatever. You got a little manager or something, not that big of a deal. If you have 20, 25, 12 even, I would say anything over 6 or 8 units that you need to start using technology to become more efficient and also to be communicating with the tenant base. When the tenants are not technologically savvy, whether they don't text message, they don't email, they're senior citizens, whatever their situation is, but they're not either on auto pay or on some sort of platform where they can communicate with you kind of online, it increases your management intensity, right? It becomes higher maintenance when you deal with tenants like that. And sometimes they're the best tenants, because they don't bother you all the time. They bother you once a month and it's when the check comes and that kind of stuff. But maximizing efficiency through technology with your tenant communication, your rent receiving, your security deposit holding, your lease signing, your document retention, all of that stuff is critical. And you could spend some time on maximizing that instead of spending the time physically in the building, spend the time in the office and improve on all of those efficiencies. And you'll see how quickly some of those admin uh the time you spend in the administrative side can be shrunk really, really quickly. And that's a big deal. And response time to your tenants from a maintenance standpoint is going to add tremendous value to the tenant experience and hopefully translate into longer tenancies. You want those renewals. You want the tenant to stay. You don't want that unless it's a problem tenant, you don't want your tenant ever to leave. And so long as you kind of have an inflationary increase or some sort of cost of living increase going on with your rent renewals, you want to keep your tenants forever. And the best way to keep your tenants forever is to have them fall in love with the experience. And by doing that, they're going to fall in love. They're going to be satisfied with the unit. They're already satisfied with the location, or you hope that they are. And that's the number one way to keep that net income up is tenant retention. So, you know, a lot of times I hear from buyers, I'm looking for value add, I'm looking for value add, I'm looking for value add. Value add doesn't always mean kitchens and bathrooms. It just doesn't. Sometimes it means the a stroke of a pen can add a ton of value in multifamily apartment building investing. And you see it on the commercial side with leases. How you structure a lease automatically either increases or decreases the value of the property. It has nothing to do with the color of the brick. So, keep that in mind. Now, as far as the color of the brick goes, I do think that there's a ton of value to dressing up the curb appeal of a property. There are a lot of 1960s, 1970s era buildings out there that aren't the prettiest, but they're very easy to operate and to manage the way that they were built. They're straight, you're not dealing with 1920s and, moving, structural issues and stuff like that. Typically, a lot of them are concrete floors, precast concrete. So you have an opportunity to maybe look at the curb appeal of the building and change the whole brand of the property so that when somebody comes in, they focus right away. Oh my God, look at this, a beautiful building you're walking into. The hallways are beautiful, the windows, the lighting is great. It just has a really, really great feel. So the apartment itself, although it has to appeal to the tenant who's going to live there, you can probably get away without spending hundreds of thousands of dollars on interior renovations when you can uh, maybe charge a little bit less, spruce up raise the quality of the tenant by making sure that they're technologically savvy and improving that first impression when you walk in. The apartment's going to be clean, it's going to be modern. It may not be condo quality to 2026 standards, but which building, what 1960s building or 1970s building really is or 80s. You got to spend a lot of money to go in to do that. And then, on the front end, do you have that money to do it? Is it really going to move the needle? Are you willing to spend $10,000 to raise the rent $150 a month? I don't know. Maybe you are, maybe you're not. Is it going to take $10,000? Maybe it'll take more. So, those are all things that you got to do, but you kind of learn that on the ground. A lot of gurus out there on the internet. A lot of people looking to invest in multifamily real estate, passive income, passive real estate. I want to get to 100 doors. I want to get to 100 doors. You don't get to 100 doors by starting with 100. Very, very difficult to do. You start with two, maybe four, and get used to what it takes to talk to tenants, to lease apartments, to make small repairs. Um, no matter what, you're going to have to do stuff to the building inside the building. Now, whether you bring on a partner that maybe is a little bit handy or whatnot, but there are things that you're going to have to do. I've painted apartments, I've changed faucets, I've laid tile, you just got to kind of do all that stuff. Now, look, if you're some sort of high level person and you're going to go straight to the top, you better have a really, really tight team where you're the money guy and you're going to turn the money over, buy the building, and have the team in place. But I'm telling you, third party management isn't a walk in the park all the time either. So sometimes it just means a lot. If you want to get into this business, get into the business with a 2 unit or a 4 unit. Don't expect that you're going to have some kind of major cash flow. You're going to have some tax write-off. You're going to have a little cash in your pocket, and hopefully you're going to see some appreciation over time. You can improve the property, raise the value. Maybe you refinance and you take some money out, and that's how you kind of grow. Um, but I don't know. The idea of going straight as a novice to, 50 units or something like that and having no experience and no team behind you, very, very difficult to do. Very difficult. Be careful. Be really careful. Make sure you have good mentors and good physical people on the ground. You need physical people on the ground. So I don't know. I can kind of go on and on about this. I have been off of the management side for quite a while now and focused a little bit more on the brokerage side. And I'm seeing a bunch of different things. I'm seeing the values come back to, so you look at Chicago, right? Let's look at Chicago. Chicago itself, you see a lot of rent growth. It's a Midwest city. It hasn't gotten killed by a lot of that crazy construction boom that happened on the Sun Belt. And everybody still wants to live in Chicago. The population is growing. The rents are going up. It's a great place to invest. You're going to pay much more money than you are in, say, a Cleveland market, but you're going to see that appreciation probably more clearly than you will in a Cleveland market. The Cleveland market is going to be a little bit more stable, although it has increased a ton, spooking a lot of local investors and a lot of local owners
Mhm.
because although their properties have increased in value tremendously, they can't wrap their head around how some of these buildings are being sold at the prices they are to out-of-state investors. And out-of-state investors are looking at Cleveland a lot differently than local investors are. So at some point, that's going to bridge and the prices are going to be coming down a little bit so that local buyers are going to come into the market. And when you have that local expertise and local experience, it's going to be a good qualified buyer. And, from a financing standpoint, it's a lot easier to get financing from a local operator than it is from an out-of-state operator, uh, unless it's like a cash deal or something like that, or, there are other circumstances. So, it's nice working with the local people because they understand the market, they know the market, but because of that, they will beat you up on the price. Um, but they know what they're doing. They know what they're doing. And if you've got already a portfolio of properties and you buy another one to fold into that portfolio, there's some efficiencies there that maybe you can maximize and take advantage of. So anyway, the last deal I did was a 2 unit. The deal before that was a 44 unit. So my scope is wide. I don't really discriminate, but I do like dealing with sellers that are good operators. And the buildings are taken care of. There's some pride of ownership there. There's experience. They know what to expect. And it does make for a pretty good transaction. I've partnered with a lot of these guys and done multiple deals with multiple sellers in town here. And if you're looking to buy or to sell, you're local to the Cleveland market or the Chicago market or even South Florida, I'd love to have a conversation and see what you're doing with your buildings, where you're at in the ownership life cycle of some of these deals, lifestyle too, frankly. If you've been in the business for 20, 25 years, you may want a little bit of a change of lifestyle. Um, but it depends on how you operate your stuff, what kind of efficiencies you made, what kind of team you've got behind you. And but I'd love to have all the conversations and talk tax strategy and exit strategy and succession plans and all that stuff. All that goes into the conversation when you're selling an apartment building that you've owned for quite a while. So anyway, if you have any questions, you know where to reach me. You can always call me at 312-493-8171. Find me on YouTube, Facebook, LinkedIn, wherever you need to. This is Chris at the Real Estate Machine Show. Hope to see you guys real soon.